All right, let's get right into it. There's a really powerful market signal that just flashed, and it suggests that when a year starts off strong, it tends to stay strong. Today, we're going to break down an analysis that ties this historic indicator, the Federal Reserve's latest moves, and what it all could mean for both your crypto and your stocks. So here's the big question at the heart of all of this. What if the market's performance in just the first few days of trading could actually tell us what's going to happen for the rest of the year? Now, according to the analysis we're digging into, this isn't just some random idea. It's a historical theory with some pretty surprising data to back it up. And that leads us to this first key concept, something called the first 5-day rule. This observation, which was really popularized by market strategist Tom Lee, is a super simple but powerful way to get a read on the market's mood for the year ahead. The rule is, well, pretty much what it sounds like, and the logic isn't magic or anything. It's all about investor sentiment. Think about it. If a bunch of new money is flowing into the market right at the start of the year, after all the tax-related selling in December is done, it signals a kind of broad optimism that can really keep rallies going. Now, this is where it gets really interesting. Check out this stat. According to the analysis, if you go all the way back to 1950, whenever stocks were up in the first 5 days of January, the full year ended up higher an incredible 84% of the time. That's a pretty strong track record. And it's not just that the market finished in the green. In those positive years, the average return was a very, very healthy 16%. Now, that's a compelling statistic for sure, but it's really only one piece of the puzzle. The other, and you could argue much bigger piece, is the whole economic environment that could basically supercharge this effect. Which takes us right to our second section, what the U.S. Federal Reserve is up to. Because if there's one golden rule in investing, it's that you absolutely have to pay attention to what the central bank is doing with the money supply. Yeah, the source material puts it pretty bluntly with this classic Wall Street saying, look, trying to bet against the Fed's policy is usually a losing game. When they were tightening things up back in 2021, the markets definitely felt that pain. So the big question is, what are they doing right now? And this slide just lays out the shift perfectly. Back in 2021, the Fed was all about quantitative tightening. That's just a fancy way of saying they were pulling money out of the system and hiking interest rates to cool things down. But today, the situation has totally flipped. The Fed has stopped tightening and, according to this analysis, is now doing what some people are calling stealth QE. Basically, they're quietly injecting money back into the market, even if they're calling it technical adjustments. So, how much money are we talking about? Well, the analysis claims the Fed is currently pumping somewhere between $30 and $40 billion back into the market every single month. And if you zoom out, the big bank analysts are predicting that this could add up to anywhere from $300 billion to $500 billion of new cash being pumped into the system this year. That is a massive tailwind for risk assets like stocks and crypto, and it's exactly the kind of fuel that can turn a positive signal into a seriously powerful rally. Okay, so how does this all translate to the crypto world? If we have this historic green light from the market, and the Fed is adding fuel to the fire, what does that mean for something like Bitcoin? Well, the technical picture for Bitcoin is described in the source as just cool and normal. This recent dip we've seen isn't viewed as a red flag, but more like a healthy breather. The price is testing a key support level, the 50-day EMA, which is just a way to track the average price trend, and it's forming a classic triangle pattern. This usually suggests an asset is just coiling up for its next big move, and that the appetite from investors is still really strong. The analyst uses a great analogy for this. A healthy market is like a fine wine. You gotta let it breathe. It doesn't just go straight up in one shot. This 2 steps forward, 1 step back kind of movement is what builds a really sustainable, healthy trend, instead of just a crazy, short-lived pump. Now, this whole idea isn't just about crypto. The source also applies this combo of positive signals to a few specific stocks that a lot of people are watching right now. The analysis points out 3 in particular. First up is MicroStrategy. Now that all the fear about it being delisted is over, the source suggests it could actually be set to outperform Bitcoin itself. Next is Tesla, which is also in a big triangle pattern and testing support. The analysis flags its 200-day moving average, a key long-term trend line, as a potential prime spot to buy. And finally, you've got AMD, which is seen as more of a long-term hold that might just trade sideways for a few more months before a potential major breakout. Okay, so it all sounds pretty bullish, right? But, and there is always a but, no analysis is complete without looking at the other side of the coin. So what are the risks? What's the big caveat to this whole optimistic outlook? Well, the base case, even for a lot of the bears out there, is that we're in for a pretty significant release rally in the first part of the year. The combination of the positive historical signal and the Fed adding cash is just seen as too powerful to ignore in the short term. So that's kind of the minimum expectation. But here's the counterargument. What if this rally is just that, a temporary bounce, before the market completely rolls over and heads dramatically lower? This is the danger zone scenario. The rally acts as a trap, luring everyone in before a much, much bigger downturn later in the year. So, this is the crucial point. Even with this strong start, the source notes that a lot of analysts are still predicting a major 15 to 20% correction for the stock market at some point this year, maybe around the middle of the year or as we get closer to the elections. And that leaves us with the big multi-trillion-dollar question. On one hand, you've got this powerful historic signal combined with a Fed that's pumping money into the system, which points to a strong year. But on the other hand, there's this very real risk that it's all just a temporary rally before a significant drop. So is this early strength the real deal, or is it just noise before the storm? That's what we're all waiting to find out.